A call option gives you the right to buy a certain asset on a certain day at a certain price. That price is the exercise price or the strike price. They mean the same thing. Now there's no such thing as a free option, so if you're going to buy the option, I will charge you a premium up front. Sometimes the option seller will defer the premium so you can pay it later on. It depends on how much they like you and your counterparty credit risk. So let's just imagine you're going to buy an option on oil, nice and tangible. So you have the barrel of oil in front of you and you have the option to buy it, or call it over here, at $60 a barrel. Now let's say for this example, the premium or the cost of that option is $5. So imagine you literally put $5 in cash on that barrel of oil. You're not going to get the money back. So when you look at the payoff, you have a $5 cost. But once oil gets to $60 a barrel, now it's interesting, because if oil goes to 61, 62, 63 and so on, lucky you, you don't have to pay 63, you only have to pay 60. In fact, once oil has gone up to $65 a barrel, you've now broken even because you've made a $5 profit on your option, which covers the cost of that option, which was $5. So $65 per barrel would be your break even. Anything beyond that is pure profit on your option position. So what we're trying to do is see how much that option moves up in value by and use that profit to offset the cost of buying oil from another supplier at the higher price, and they should help offset each other. So that's a call option. Now that's where you're buying it, where you're going long a call. So if you're long, you've bought it. But what if you don't think prices are going to go up and you're feeling a bit adventurous and you sell or write a call option? So selling and writing is the same thing. So you sell an option to somebody to buy it at $60 a barrel. Now if you sell an option, I will pay you. So you make $5. And as long as oil doesn't go above $60, if it stays at 50, 40, 30, you keep that premium, nice. But if oil does go up, you're starting to have to pay out money. And if you're not careful, oil could go through the roof. There could be some geopolitical conflict. Oil goes to $100, $150 a barrel. You're losing a lot of money. So if you are going to sell or write an option, make sure you know the consequence, make sure it's suitable and appropriate for your risk strategy, and just make sure you're actually allowed to do that if you work for an institution.